Every major financial collapse of the last century has followed the same path. Not a similar one, not something that just happens to rhyme, the exact same sequence. It happened in 1929. It happened again in 1987, in 2000, and in 2008. 5 stages, always in the same order, always visible months or even years before everything breaks. Wall Street knows this pattern. Central banks know it. The people managing money for billionaires know it very well. Most ordinary people do not. And that is not an accident. Because if people recognized the pattern early, they would step aside before the collapse instead of absorbing the damage afterward. Today, I am going to walk you through all 5 stages, and I am going to show you exactly where we are right now. The uncomfortable truth is this: we are much further along than most people realize. In 1929, a man named Roger Babson stood on a stage at a business conference and said 9 words that made him the most hated man on Wall Street. Sooner or later, a crash is coming, and it may be terrific. People laughed. Newspapers mocked him. The most famous economist of the era publicly dismissed him and claimed stocks had reached a permanently high plateau. 47 days later, the market collapsed. The economist lost everything and died broke. Babson went on to build a fortune. This was not luck. Babson was not guessing. He had developed a framework for identifying financial collapses before they happened, a system built on 5 conditions that always appear before a crash. I spent months studying historical data, Federal Reserve records, and academic research to test whether this framework actually holds up. It does, every single time. Stage 1 is always the same: a credit explosion. Crashes do not begin with fear, they begin with debt. Before every major collapse, borrowing grows faster than the real economy. People take on debt they cannot realistically repay. That debt flows into assets. Asset prices rise. Rising prices create the illusion of wealth, and that illusion encourages even more borrowing. It feels like prosperity, but it is leverage disguising itself as growth. In the late 1920s, Americans borrowed up to 90% of the money needed to buy stocks. By 1929, margin debt had grown to the size of the entire federal budget. In 2007, the same pattern appeared through housing. Debt was hidden inside complex financial products. The leverage was everywhere, even if people could not see it. In 2000, it was corporate debt. Companies with no profits borrowed billions using inflated stock prices as collateral. Today, the scale is even larger. Official margin debt alone is near record levels, but that only shows a small part of the picture. When you include borrowing against investment portfolios, options market leverage, corporate debt exceeding $10 trillion, and government debt crossing $34 trillion, the reality becomes clear. Total debt relative to economic output is now higher than at any point in modern history. Stage 1 is not a warning light anymore. It is a fire. Stage 2 is the concentration trap. Markets do not collapse simply because prices are high. They collapse when risk becomes concentrated in too few places. In 1929, a handful of glamour stocks dominated the market. In 2000, a small group of technology companies carried the entire index. In 2008, concentration hid inside the banking system. Today, it is visible to everyone. A small group of mega-cap stocks now represents a massive share of the total market. Most retirement accounts are effectively bets on the same few companies. Passive investing has amplified this problem. Money flowing into index funds automatically pushes the largest stocks higher. That increases their weight, which attracts even more money. It works beautifully on the way up and violently on the way down. Stage 3 is the quiet exit of smart money. This is the most uncomfortable stage because it exposes how the system actually works.
Before every crash, institutions begin reducing exposure. They sell quietly, they raise cash, they buy protection. Publicly, they sound confident. Privately, they are leaving. In 1929, major financial families were liquidating months before the crash. In 2007, institutions bet against the same products they were selling to clients. Today, corporate insiders are selling at historically extreme levels. Meanwhile, retail investors continue buying through passive flows and retirement contributions. This is not coincidence. It is the pattern repeating. Stage 4 is the liquidity illusion. This is where everything still looks fine on the surface. Prices hold, markets appear stable, but the liquidity supporting them is draining away. Liquidity is the oxygen of markets. When it disappears, prices do not decline slowly, they gap lower. The Federal Reserve has tightened policy at the fastest pace in decades. Liquidity has been pulled from the system. We already saw early cracks when multiple banks failed in a single week. Emergency programs stepped in to prevent collapse. Those programs delay the problem, they do not solve it. Stage 5 is the trigger. This is the only stage that cannot be predicted. The trigger does not cause the crash, it simply reveals a system that is already unstable. In 1929, a relatively small foreign financial event started the chain reaction. In 2008, it was Lehman Brothers. This time, the trigger could be geopolitical, financial, political, or something no one is watching. When the first 4 stages are in place, the trigger usually arrives within 1 to 2 years. We are already there. This does not mean panic. It does not mean hiding. It means understanding reality. History does not punish ignorance. It punishes unpreparedness. Roger Babson survived because he respected the pattern. Others ignored it. The same choice exists today. This is not financial advice. This is historical analysis. And history is very clear. The pattern is repeating. What you do with that knowledge is up to you. This is Legacy of Money.